Everybody is unique. Everyone has a different way of analyzing the market, different needs, different risk tolerances, and different amounts of time. All investors are susceptible to cognitive biases. It's up to you to learn to recognize yours and take the steps to reduce the potentially negative impact of those biases. Not everyone is a buy and hold investor, and not everyone is an active trader. Where you fit is most likely unique to you. While it is good to acknowledge your unique situation and your personal approach to investing, it can be useful to understand some general tendencies of different types of investors and see if you can learn from them and apply the lessons learned to yourself. According to a Journal of Financial Planning article written in October 2008 by Michael Pompian, investors fall into 4 basic behavioral categories. The categories are passive preservers, friendly followers, independent individualists, and active accumulators. Each of these types of investors have their own approach and their own cognitive biases that could impact their investment performance. Understanding your potential blind spots and opening your eyes to those could help you improve your behavioral alpha. Alpha is a measurement of return against a benchmark. For example, if your benchmark was the S&P 500 and the S&P 500 returned 15% one year, while you had a personal return of 20%, you would have a positive alpha. Behavioral alpha is a measurement of how much your returns are improved by reducing the impact of cognitive biases on your investing. Passive preservers are investors who are focused primarily on financial security. They tend to have a low level of risk tolerance and can sometimes focus too much on short-term fluctuations and worry about making any changes in their approach. They're often afraid to make investment decisions due to a fear of making the wrong choice, often called analysis paralysis. Passive preservers tend to have a strong loss aversion bias, information bias, and tend to want to stick with the status quo. Passive preservers could potentially improve their investing by developing a system of rules that they trust and sticking with them. Friendly followers are investors with low to medium risk tolerance. They tend to want to be invested in whatever the latest hot trends are. They could suffer from recency bias, herd mentality, and hindsight bias. They can also suffer from the disposition effect, which can cause them to mismanage their existing positions. Friendly followers can potentially improve their investing results by focusing on a system of investing rules that helps to limit their impulsive tendencies. Independent individualists tend to be medium to higher risk investors. They tend to spend a lot of time doing independent research and they trust their own conclusions. Unfortunately, this can lead to confirmation bias, self-attribution bias, and a tendency to hold on to losing investments even when facts have changed or proven to be incorrect. Independent individualists could potentially improve their trading by furthering their education, actively studying research counter to their initial thoughts, and have a good set of risk control rules that define when to exit a losing trade. Active accumulators have a high risk tolerance. They're often entrepreneurial and they have a lot of confidence in their abilities. They tend to invest in a way that has high risk and high return. They can suffer from the illusion of control and overconfidence in their approach. Active accumulators can sometimes be irrational with their approach and take investment chances that data doesn't actually back up. They also tend to overtrade. Active accumulators could potentially improve their investing by following a rigid set of rules that include position sizing and limiting the number of trades they can take in a given period. Take the time to watch our series of videos on cognitive biases. Whether you're a short-term active trader or a longer-term investor, figure out what investing personality you have and use your strengths to your advantage while reducing the potential negative impacts of cognitive bias on your investment returns.